Hey everybody, welcome back to another beautiful day in real estate. Yesterday we were dealing with some family. Everybody in the house had bug but me, so I was kind of helping around and I didn't have time to do a video, so we're going to jump in today. There's a ton of things happening in the news, whether that's banking, whether that's real estate, the Federal Reserve president being confirmed. I mean, there's a whole lot of stuff we're going to go over here today, so let's just jump into current events and how that's affecting and shifting the real estate market, okay? First off, interest rates are on their way up today. Why are they on their way up? Well, it's because we still haven't got a deal from Iran, a peace deal taken care of. So they have, you've seen bond prices kind of take off as people are looking for higher risk assets because they're preparing for inflation currently, right? Everybody right now is kind of preparing for inflation because, well, money printers have been turned back on. I don't know if people have been paying attention, but the amount of liquidity getting pushed in to the economy lately is in the billions and above 15 billion, right? So when you see that much money monthly, I think in the month of April there was 16 billion that was printed and put into United States or put into the economy. So when we see something like this, that just means the devaluation of the dollar is continuously going down, which means that major investors and smart investors are looking for higher risk assets because when you have money being pushed into the economy, high risk assets are going to be going up. Not even necessarily higher risk, but literally any physical assets, right? Real estate, number one, right? Don't know how to tell people this anymore, but real estate's the number one in my opinion. Okay, you've got different things such as Bitcoin. You have different things such as the S&P 500. These are going to be the major things that people talk about currently, right? The housing prices, I have a unique video to show. It's a little longer, but we're going to go through it. It's Kevin Warsh being interviewed, and he was talking about how he plans to restructure the Federal Reserve. And we've talked about that before. And now that he's officially confirmed as of yesterday, I think it was 49 to 44 vote, and he is officially confirmed for the next 4-year period as the new head of the Fed president. Head of the Federal Reserve as Fed president. That's going to be a big shifter. So I'm not going to get too sidetracked on things today. Let's talk oil. We'll talk a little bit about bond prices, and then we'll jump into the current news. Okay. So, oops, let's get rid of that. They always do sales. Okay. So we have noticed a couple of things. Let's go all the way back. We talked about this. The war in Iran starts, right? And it kind of consolidates. They say we got a peace deal. Never mind. They got a peace deal again. Never mind. Right now we're kind of tolerating right here between $194 a barrel currently. And why is that? Well, we're waiting in anticipation for a peace deal to happen. There's no confirmation that it's not happening, but there's also no confirmation that it is happening. So oil prices are kind of staying stagnant. Unfortunately, gas prices keep going up, which is unfortunate, but it's part of what we're witnessing, right? It's the same stuff that happens every time you see a conflict kick in. Oil is the biggest commodity in the world, and when that commodity is being restricted to a certain extent, as it is in the Strait of Hormuz, it just means that more people, it just means that getting the products harder. When getting the products harder, obviously it's more expensive, right? That's just how it works. That's how economics work. So until we see a peace deal, we're not going to expect any major movement up or down. We're going to expect to see some consolidation, right? And that consolidation is continuing between $101 and $94. I mean, ever since the beginning of, since May 8th, right? So we're just over a week into that, and it's been consolidating since then, right? Because this is when the last peace deal came. They said that they didn't like it, so the prices went back up. Now they're coming back down again, right? So right now, again, it's just been a waiting pattern, but the thing that I don't think we're all paying attention to is the amount of distractions that are going on right now. We're talking about the Clarity Act is to be voted on at 10:30 EST, so that means that it's going to be voted at 9:30 Central Time. You've got the big news story, right? You have Trump and 20 CEOs from the United States, 20 visiting the president of China and working on a deal. I don't think people are paying attention to how important that is, okay? And we're going to touch on that and why that's so important in just a second. But so oil prices, they're kind of sitting where they're sitting, right? 10-year treasury bonds have seen in my opinion, this is going to be a top, right? When we see a reverse hammer like this typically means we're going down. How far down is going to be kind of unexpected. I think that what happens in China is really going to defer, and what's happening with Trump and President Xi, it's going to determine how the markets move pretty significantly, right? And he's going to be there for the next few days, so we'll kind of have to see how everything plays out. But let's bond prices sitting where they're at. Let's see S&P 500. S&P 500 sitting at all-time highs once again, you guys. We saw a nice little peak right away in this morning. or yesterday, excuse me. And then the markets will open just about 15 minutes ago. So for right now, what was the new all-time high yesterday? 7,456. There's been talks of it going all the way up to 10,000 in the next few years. Is it possible? Yes. We'll see. We'll see. We'll see. But so now the big news that's going on, you guys, big news that's going on is 30 days ago, China and America were at war, tariffs, sanctions, treasury dumps, Iranian oil deals, the most hostile relationship between the superpowers in decades. So let's just put this into perspective. The United States economy and China's economy are the biggest two economies in the entire world. Now imagine, now today Trump and Xi, Xi, I can never say his name right, are sitting across from each other discussing a $1 trillion deal. China builds factories on American soil, $1 trillion in Chinese investment, creating American jobs, fueling American growth. The country that was dumping U.S. treasuries last month is now buying the American economy. The greatest geopolitical reverse in modern history, and it happened in 30 days. So those of you that don't know, China has not been necessarily an ally for the last decade, right? They have taken away and they have created such cheap product that it's removed a lot of opportunity for growth in the United States, right? Because when you can buy a product for cents on the dollar, why would you build it for dollars on dollars, right? So essentially what that means is, why would you build something for more when you can buy it for less, right? And that's exactly what's happened. Well, because of that, they've actually strangled and they have created a monopolization where they can make the rules when it comes to trades. When you have something of that nature, it becomes dangerous, right? Because all it takes is them to say, hey, we're not going to trade with you anymore. And when 60, 70% of our product comes from China, then all of a sudden you're castrating one of the largest economies. But to the caveat to that, if you take away your biggest buyer and you're not producing, then you're also losing money over here, right? So it's a constant, almost like a sibling relationship where they're butting heads constantly, but nothing really bad is happening, right? But now, we had the tariff wars where they were saying, well, 100% tariffs, 120% tariffs. It was like two toddlers going back and forth saying, nope, it's going to be more expensive here. Nope, we're going to charge you more. We're going to charge you more. And then here we are, and they're sitting across from each other with 20 different CEOs from the United States. Everybody from Tim Cook to Elon Musk, just Apple CEO. You've got the NVIDIA CEO. He joined them last minute too. You guys, if they can come to a deal, where NVIDIA being a big bargaining chip in Taiwan currently, right? They come to a deal where they can come to an agreement with NVIDIA. And NVIDIA, I don't know if you guys know this, have promised to introduce some money and factories in the United States to build computer chips, right? Which is huge because AI is becoming such a broad and powerful thing, right? Big stuff on that notion, right? So if China and the United States can agree on how NVIDIA operates as far as building being the biggest chip builder in the world, you come to an agreement there. You come to an agreement on trade. You come to an agreement on being an ally versus an adversary when you're talking about the Iran war. Just this week alone, you could end the Iran war, you could create a better trade deal, you could lock in more jobs in the economy, new investments, and create peace across the world. And two of the biggest economies, the two biggest economies allied next to each other, could completely shift the way that everything is going to be in a year from now. This is one of the biggest meetings of 2026, and it's crazy to me how glossed over it is, because it seems like we have so many crazy news stories at this point that nobody really pays attention and looks at it from a 30,000-foot overview, right? Everybody's locked into the straightforward, what's going on, everybody's very short-sighted and they're more focused on the immediate reaction rather than what could happen in the next year, 2 years, 3 years, decade, all that fun stuff, right? So this is going to be a big thing. They're meeting this week, and it's going to kind of it's going to determine how the market continues to move. It's going to continue, it's going to decide how the current trades are moving. Tariffs. It's going to decide. Decide independence between these two countries. How independent are we actually between the two countries? It's going to decide. I mean, really, the biggest ally for Iran is China, and if China becomes an ally with the United States, all of a sudden they have absolutely nothing backing them. And not one to say one thing or the other, but we're just not off to a good start there for Iran, right? Ideally, they come to a good deal this next week. The Strait of Hormuz opens and money continues to print into the economy. I'm not saying it's a good thing, but it's possible. If that happens, we are going to see a very strong and booming economy. Trump did post on Truth Social the other day, and he did say it's time to buy stocks, it's time to buy crypto. We're about to see an explosion in the economy like never seen before. And whatever your opinions are of them, from a business perspective, these things look good. It looks really good right now. I am very confident that the next few years we're going to do very, very well. And the other thing that correlates with that, and another big piece of news, is that the Clarity Act is finally getting voted on today. Finally getting voted on, like I said, not 10:30 EST or Eastern Standard Time. And if this passes, this will create a regulatory framework across the board for blockchain and cryptocurrencies. If you've been paying attention, the amount of implication in blockchain, AI, Bitcoin, all of these crypto and blockchain-based companies will then have clarity to build in one place, one of the biggest economies in the world. See, the thing is, Trump talked about growing out of the deficit that we are currently in as a country. Not printing money into oblivion, not devaluating the dollar, but growing, okay? Don't get me wrong, growth comes with the devaluation of the dollar, but not to the significance of just printing money and setting it to the side, right? So all of these things, if they work in the favor that they could completely shift how the next 2 decades of trade, the next 2 decades of businesses, the next 2 decades of data transfer, money transfer, all of it as a whole, an entire system could be completely revamped and modernized to create the opportunity for an economy to grow significantly. And if you are dominant in AI, you're dominant in crypto, you're dominant in trade, you're dominant as an economy as a whole across the world, you're holding 4 of the strongest pillars anywhere. And when you have that much power, you have the ability to make big decisions that could shape the world, how the world works, right? So Kevin Warsh was confirmed yesterday by the Senate. This video is a little longer. Bear with me, but this is a very good video to be paying attention to. We'll kind of break it up as we go through it, okay?
For reform that won't make matters worse.
Yes, well, this might upset part of your audience, Peter. So this is a trigger warning. This is what people like you and I do on campus. I believe this administration inherited a mess, a fiscal and monetary mess. And it is incumbent on the administration to get out of it. No one said it would be easy.
Okay, so what he's talking about is this administration stepped into a place where there was extreme budget deficits, money was being printed, it was devalued, inflation was high, the trade deals were extremely unsuccessful, etc.
We didn't get into this mess overnight. We're not going to get out of it overnight. To make the numbers you said somewhat easier, I think, to understand, we were paying about $1 billion in interest expense every day the day before COVID. We're now paying more than $3 billion per day in interest expense.
So we tripled the amount of interest expense per day since the beginning of 2020. In 6 years, we tripled the amount of money that we're paying in interest. Interest. That's not paying principal of the debt that we have. That's paying the interest.
None of that's going to strengthen the military or help the least well-off among us. That is being squandered away. So what do I suggest? As you pointed out, and as you and I have discussed, but I'm not sure the economics profession believes this, there are 2 monetary policy instruments. One is setting of interest rates,
right,
and the other is this money we keep talking about. We call it QE, we call it the central bank's balance sheet. If we would run the printing press a little quieter, we could then have lower interest rates. Because what we're doing right now is we have all this money that's being flooded into the system, which causes inflation to be above target. That's the $7 trillion balance sheet.
So he's talking about the amount of money being printed and putting into the economy is creating the inflation that we're currently seeing. So when you see a giant, and that's the whole reason we saw inflation between the beginning of COVID to the end of COVID and where we are now, because so much money was printed. Stimulus, quantitative easing was so significantly high. They were printing so much money. They were giving away so much money. The balance sheet significantly rose the amount of money in the economy, which means that the value of the dollar continued to decrease, which means that it was worth less, which means it costs more for product, right?
Sheet you're talking about, an order of magnitude larger than when I joined the Fed. And at the same time, you have another monetary policy instrument, and that's interest rates. They don't work perfectly together. They're not perfect substitutes for each, but they're both monetary policy. And too many that are in the central banking business say, no, 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 that balance sheet has nothing to do with monetary policy.
So he's talking about interest rates and quantitative easing are directly affecting the economy, not just one or the other. Typically, you're going to see an argument that interest rates are the reason the economy is here. Others are going to say that the value, the printing money is why we're here, where we're here. But it's a correlation of two, right?
Well, if it did when you were growing it, it should have something to do with the conduct of monetary policy when it's going the other direction. I think we have to be honest about these two instruments. And because I believe that growing the real economy is the more important piece for revenue, for fairness, for efficiency and growth, because you have higher inflation caused by the bigger balance sheet, we want to shrink that. We can't.
So they want to shrink the amount of money that is in the economy. Currently, that would be considered quantitative tightening. So quantitative tightening is what they've been doing for the last few years until most recent, which they stopped the printing press and started pulling money out of the economy, less money in circulation to strengthen the dollar and its value behind it.
Do it overnight. We want the Treasury Department and the Federal Reserve to come to some accord, much like the Treasury and the Federal Reserve came to in 1951. Who's responsible for what? Who's going to be managing interest rates? The Federal Reserve. Who's going to be handling fiscal accounts? The Treasury Department.
Talking about separating the two again and restructuring the way that the Federal Reserve operates and the way that the Secretary of State operates. You have Scott Bessent, Secretary of State. You have Kevin Warsh, the head Fed president of the Federal Reserve.
We have blurred these lines about who's responsible. And when a president comes to power, his Treasury Secretary should be responsible for as the fiscal authority instead of blurring that over to the Federal Reserve, which only brings politics to the Federal Reserve and I would say interrupts their normal, ordinary course. In my judgment, we should be shrinking the central bank balance sheet, taking the Fed out of these markets unless and until there's a crisis. And in so
he's talking about having the Federal Reserve stop printing money or stop giving the ability to print money and restricting the amount of access it has to the money supply.
You'd have less inflation that way. You and I might call that a practical monetarism. I think that's what our
by less money being printed, you have less cause for inflation.
Intellectual heirs might be thinking about, intellectual teachers might be thinking about. And in so doing, you might actually be able to pull off lower interest rates, which matter more to the real economy.
So he's saying that by printing less money, we have less inflation, which gives us the ability to have less of an interest rate. See, everybody believes that Kevin Warsh was going to step in and he was going to immediately print money and bring interest rates down. He's going the opposite direction because when you print money, you devalue the dollar, you create more inflation. You can't just print money into oblivion. The dollar will continue to be worth less. So the way to explain it is if you're making $100,000 a year and you have a 3% inflation and you don't get a raise the next year, your $100,000 is only worth $97,000. It's a slow taxation on your current buying power. And if you don't create a different way, you're going to continue to lose money as you're making $150,000, but next year it's worth this, and then this, and then this, and then this, and this. And you're not seeing wage increases to the amount of inflation currently.
Than the balance sheet.
All right. Agenda for reform.
So what we're going to see is we're going to see a Fed president completely change the way that he's going to be operating as a Federal Reserve. That is going to shift the way that everything is, and it's going to change the way that we are operating as an economy. And I'm honestly very excited for this. There's a lot of people that aren't, but here's the thing. We need a change because the old way is not working. We've tried it for 100 years. It's no longer working. I'm reading Coach JV's new book, and he's provided tons of information, even in the first few chapters, and I'm excited to continue to read. But it's opened my eyes to see things from a different perspective, and it's not all about politics. It's about policy. It's about how we manage things. It's how we handle things, and it's about how we work with our allies and other peers across the world. So for right now, everything is changing, and it's changing all at once. For years, we have talked about the cryptocurrency space. We've talked about Federal Reserve interest rates. We've talked about inflation. We've talked about the valuation of homes. All of these things are changing the way that they are going to be operating over the next few years. So it's important that as we go through this, we understand as the process moves so that we can structure ourselves and set ourselves up for success. And many people will not. They're going to look at the stories, they're going to read the headlines, they're going to let their emotion take over rather than guide themselves through this process to create a better life for their friends, family, because the easy way out is complaining. The hard way is understanding, learning, and developing a way to become successful in an economy that is on the verge of booming. So that is what I'm excited for. All other stories aside, currently, we have good things coming in the next few years. I'm going to say it again. Buying homes is your best opportunity. There's one thing more I'll show you today, and then we got to get out of here because we're running out of time. But right now, housing supply hits the same as levels as it was in 2020. Then they said the next levels are 2016. So the market is normalizing. Normalizing. It's not crashing. If it was crashing, we would see a whole lot more strenuous issues. Right now, homes in my state, again, house got listed yesterday. My client wanted to go look at it. It had so many showings, we couldn't even get in to look at the property yesterday. People are getting normalized to the interest rates in the 6% range. People are normalizing where we're currently at. The market for real estate is not on the verge of collapsing right now. Other things are shifting. We were to a point where it was sink or swim, and right now we're treading water, but we're not swimming very far. So unless we see a shift, the real estate market could take a dump over the next 2 years. But right now, I'm staying optimistic because things are pointing in a positive way. Thank you guys for watching today. If you made it this far, make sure to like and subscribe, and we will see you soon.